Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Tesla stock. I will talk about whether I believe Tesla is a zero growth company or it will eventually recover. Specifically, I will talk about whether Tesla stock is undervalued now. Just right before I started making this video, many Wall Street analysts have downgraded Tesla stock even more because Tesla is expected to report very low vehicle delivery growth in the upcoming quarter and throughout 2024. I wouldn't be surprised if Tesla reports lower vehicle deliveries and lower earnings than expected in the upcoming quarters throughout 2024. Tesla is facing many issues right now. For example, Tesla is facing very intensive competition from Chinese competitors such as BYD. EV demand has slowed down a lot in recent quarters, and Tesla is expected to cut more prices to increase EV demand. Of course, this will continue to hurt Tesla's gross margin and operating margin throughout 2024 and very likely throughout 2025. Here's the deal, I don't like sugarcoating. I like to analyze stocks as objectively as possible. Tesla has been the worst performer in the S&P 500 this year. Many analysts expect that Tesla may drop further this year, especially if Tesla's deliveries come in lower than expected in the upcoming quarters. For example, a Wells Fargo analyst has downgraded Tesla recently. He believes that Tesla is a growth company with no growth. Here's another perspective we have to consider. Wall Street analysts tend to be very short-term focused. They tend to focus on Tesla's quarterly earnings and quarterly vehicle deliveries because that's how they're paid. Most analysts do not focus on Tesla's long-term growth prospects over the next 5 to 10 years. As a long-term investor, I think it's very important to look at Tesla's long-term growth prospects over the next 5 to 10 years and predict whether Tesla's EV business will recover over the long run. Stocks are all about the future and not about the past. So in this video, I'm going to talk about whether Tesla is a zero growth company or its EV business will recover over the long run. I will talk about whether Tesla stock is undervalued now. First, I will give you a quick stock portfolio update. Then I will talk about Tesla's biggest risk going forward. Is Tesla a zero growth company? Tesla stock valuation, and will I buy Tesla stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, watch my investing tutorial videos, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Tesla's biggest risk and long-term growth prospects, I would like to give you a quick stock portfolio update. This is one of my portfolios. I also have other portfolios that have almost the same stocks and the same investing strategy as this portfolio. Starting next week, I will use a different brokerage platform because this online broker is already acquired by another bank, so I'm forced to use a different brokerage platform going forward. Starting next week, you will see this portfolio separated into different accounts, but all the stocks will stay the same. This portfolio is beating the S&P 500 by a large margin because I have invested in some of the best companies in the S&P 500 and Nasdaq 100. I like to look for the best businesses that have large economic moats, great management teams, great products and services, great long-term prospects, increasing earnings, and increasing free cash flows over time. I have invested in many of them when they were much more undervalued before. This is why you can see there are several multi-baggers in this portfolio already. Now, I did not buy all these stocks all at once. I have been buying them gradually almost every month, so these returns do not happen overnight. I do have Tesla stock in this portfolio. I have been holding it for several years already. I bought it many times before. I like to be very greedy when others are fearful. I sold Tesla shares before and made some gains, so this realized gain here offsets my temporary unrealized loss in Tesla right now. I'm not too worried about Tesla. I expect Tesla's EV business will eventually recover over the next 5 to 10 years. I'll explain it later on in this video. So let's talk about Tesla's biggest risk going forward. Here's Tesla's first biggest risk. The market already expects that Tesla's upcoming quarterly delivery growth will likely be lower than expected. Tesla is expected to have very little or no growth in 2024. For example, just right before making this video, Wall Street analysts have lowered Tesla's vehicle delivery estimate to be around 457,000 in Q1. This represents an 8% increase year over year compared to last year, which is very low. According to CNBC, the estimates for the upcoming quarter range from as low as 414,000 to as high as 511,000. As for the full year 2024, Oppenheimer analysts have estimated Tesla to deliver around 2.13 million vehicles in 2024. This is slightly lower than the previous estimate of 2.17 million vehicle deliveries in 2024. Just to compare, Tesla delivered around 1.8 million EVs in 2023. If we analyze Tesla's Q4 deliveries, that's almost 2 million vehicles a year. This vehicle growth rate will be much lower than in previous years. Tesla's management even said that Tesla's delivery growth will likely be much lower in 2024. In 2024, our vehicle volume growth rate may be notably lower than the growth rate we achieved in 2023, as our teams work on the next launch of the next generation vehicle at Gigafactory, Texas in 2024. The growth rate of deployments and revenue in our energy storage business should outpace the automotive business. All these vehicle delivery estimates suggest that Tesla will likely have very low vehicle delivery growth throughout 2024 or even 2025 because of very high interest rates in North America, Europe, and other developed countries. EV demand has decreased a lot in recent quarters. The Cybertruck will take time to ramp, and it will not contribute meaningful gross profit to Tesla until next year or even later. Tesla is facing very intense competition from Chinese EV makers that are selling EVs that are much cheaper than Tesla's Model 3 and Model Y. And Tesla will not mass produce its next gen $25,000 EV until at least 2026 or later. So Tesla has no choice but to continue lowering prices. Of course, lowering prices will hurt Tesla's margins. A few years ago, before Tesla started the price war, Tesla used to have the highest operating margin compared to the traditional automakers and the EV makers. Now, Tesla's operating margin is much lower than before. Its operating margin is comparable to other car makers, mainly because Tesla started cutting prices to increase its EV demand. At the same time, you can see that Tesla has the highest PE compared to all other automakers. Of course, this doesn't make sense if Tesla's operating margin is comparable to other automakers and its growth rate is much lower than before. This is why many investors are very bearish on Tesla right now. This is why Tesla has been the worst performer in the S&P 500 this year. It's also the worst performer compared to other Magnificent Seven stocks. The other Magnificent Seven stocks such as Nvidia, Microsoft, Apple, Google, Meta, and Amazon have very large economic moats. They are near monopolies in their sectors. It's extremely hard for competitors to copy their technologies, products, and ecosystems. This is why they don't need to lower prices to increase the demand for their products and services. On the other hand, Tesla has to lower Model 3 and Model Y prices in order to increase EV demand. This shows that Tesla still has a narrow economic moat in the EV industry, even though Tesla has one of the largest economies of scale and a very large cost advantage compared to other EV makers. So here's Tesla's biggest risk going forward. Tesla will continue to face very intense competition from Chinese EV makers such as BYD that are selling much cheaper EVs than Tesla. BYD has already surpassed Tesla as the largest EV maker in the world in terms of EV volume. One of the biggest reasons is that BYD's EVs are much cheaper than Tesla's Model 3 and Model Y. For example, BYD's new Seagull EV is starting as low as $9,700 or slightly less than $10,000, and BYD can still make a profit from selling these very cheap EVs. This shows that BYD has a much bigger cost advantage and much bigger economies of scale compared to Tesla. For example, BYD mass manufactures its own batteries, makes most of its semiconductor chips used in its cars, owns its manufacturing plants, and is vertically integrated like Tesla. Tesla is only starting to make its own in-house batteries. Tesla has not mass-produced its own in-house batteries yet. Tesla still needs to buy most of its batteries from Panasonic, LG, China CATL, and even BYD. The battery is the biggest cost in EVs, and BYD is one of the largest battery makers in the world. This is why BYD can often sell EVs that are much cheaper than Tesla. Elon Musk even said that Chinese car companies are the most competitive companies in the world. He said that if there are no trade barriers established, they will pretty much demolish most other car companies in the world, so they're extremely good. Elon Musk is right. Without the trade barriers and high tariffs, Chinese EV makers such as BYD will flood the European market and the US market with very cheap EVs, and they will take away a lot of sales from Tesla and the traditional car makers in the US and Europe. For example, many Chinese EV makers such as Xiaomi, Xpeng, NIO, and Li Auto are selling their EVs below their costs to gain market shares. Chinese EV makers are probably getting a lot of subsidies from the government there. That's why they can sell very cheap EVs at huge losses. Chinese EV makers are generally much better and more cost-effective in mass manufacturing EVs. I believe Tesla is the only EV company that can compete with the Chinese EV makers because Tesla has one of the largest economies of scale in mass manufacturing EVs. I'll talk more about this later on in this video. In terms of financials, you can see that Tesla had very high revenue growth, operating income growth, and free cash flow growth before. But going forward, Tesla's growth will likely slow down a lot this year and perhaps next year because of high interest rates, continuous price cuts, lower EV demand, and intense competition from the Chinese EV makers in China. Tesla's energy and storage business has been growing much faster than its EV business, but realistically, Tesla's energy and storage business revenue is still too small compared to its revenues from selling EVs. Tesla's energy and storage business gross profit is also too small, so I wouldn't expect Tesla's energy business to contribute large profits to Tesla anytime soon. Tesla does have a very strong balance sheet. For example, at the time of making this video, Tesla has around $29 billion in cash and only $5.23 billion in total debt. This means Tesla can pay off all its debt and Tesla will still have nearly $24 billion in cash left. So here's the important question you should ask if you're a long-term investor. Is Tesla a zero growth company or will Tesla's business eventually recover? I'm going to explain why I believe Tesla's EV business will eventually recover over the next 5 to 10 years. First of all, I believe this Wall Street analyst is completely wrong about Tesla. He believes that Tesla is a growth company with no growth. He is likely right about Tesla having little to no growth this year and even next year because of the risk and short-term headwinds I talked about earlier. But I think he's too short-term focused. He does not focus on Tesla's long-term plans and long-term growth prospects over the next 5 to 10 years. Here's the interesting part. The Wells Fargo analyst who believes that Tesla is a growth company with no growth has one of the lowest success rates, well below 50%. If you follow his recommendations and advice, you will probably lose a lot of money over time. This is my prediction. I do not believe that Tesla is a zero growth company. I believe Tesla's EV business will start recovering over the next several years for several reasons. The first reason is this. I believe that Tesla's full self-driving FSD service will continue to be the biggest breakthrough and one of the biggest growth drivers for Tesla going forward. Right before I started making this video, Tesla has released FSD V12 to most customers in the US. US customers can now have free 1-month access to Tesla's FSD V12 self-driving service. Based on what I know, Tesla's FSD V12 is a huge breakthrough compared to previous versions. FSD V12 relies on AI and Tesla's neural nets to drive the vehicle. This replaces well over 300,000 lines of C++ codes in previous FSD versions. Tesla's AI and neural nets are trained on millions of miles of driving data. This is extremely hard for competitors to copy. Tesla now uses AI to drive the car almost like a human in almost any driving environment. The current FSD V12 is essentially an AI agent on wheels. Tesla FSD will improve a lot over time as more people use FSD, which will provide more driving data to Tesla's neural nets for AI training. Elon Musk said this in the most recent earnings call. This is the first time AI is being used, not just for object perception, but for path planning and vehicle controls. We replaced 330,000 lines of C++ code with neural nets. Then he said, I think Tesla is probably the most efficient company in the world for AI inference. Out of necessity, we have actually had to be extremely good at getting the most out of hardware because hardware 3 at this point is several years old. So I think we're quite far ahead of any other company in the world in terms of AI and inference efficiency, which is going to be a very important metric in the future in many arenas. Of course, Tesla FSD is not cheap at all. At the time of making this video, FSD costs $200 per month or a one-time fee of $12,000 in the US. But here's Tesla's biggest growth opportunity going forward. If many US customers pay for FSD after the 1-month free trial period, it will increase Tesla's gross margin and possibly increase Tesla's EV sales over the long run. Realistically, I wouldn't call Tesla FSD V12 a ChatGPT moment yet until we see many customers start paying for FSD. We will know whether there will be many customers paying for FSD over the next several months. This is my prediction. Over the next 10 years, I believe most new EVs will need to have self-driving capabilities for safety reasons. Eventually, I believe most new vehicles will need to be partially or fully autonomous cars. As of now, FSD V12 is considered level 2 or even level 2 plus partial autonomy. Eventually, most new EVs will need to have at least level 3 conditional autonomy or even level 4 or level 5 full autonomy. I believe FSD will be one of Tesla's biggest growth opportunities going forward because I believe Tesla FSD will eventually reach level 4 high autonomy or even level 5 full autonomy, which will be Tesla's robotaxi service. Based on what I know, I believe Tesla's autonomous driving tech is far ahead of competitors, even the Chinese EV competitors in real-time AI inferencing and neural network training. I said this earlier, Tesla FSD will get much better over time as more people use FSD, which will provide more video data to Tesla's neural nets for AI training. Tesla's FSD is being trained on millions of miles of video data. This is extremely hard for Chinese EV competitors to copy. Based on what I know, most Chinese EV makers' autonomous driving systems need to rely on LiDARs, ultrasonic sensors, radars, high-definition mapping, and a lot of hard coding, so their systems can only work well on predefined areas and roads. Their autonomous driving systems will not work well on streets and environments they have not seen before. In comparison, Tesla's EVs do not rely on LiDARs and sensors. Instead, Tesla's latest FSD relies on computer vision, AI, real-time AI inferencing, and neural nets that are trained on millions of miles of driving data. Again, this is extremely hard for Chinese competitors to copy. For example, if a Chinese EV maker such as BYD wants to develop an AI neural network like Tesla, it will need to have a large amount of compute, buy over 10,000 NVIDIA AI GPUs for AI training and AI inferencing, develop their computer vision AI models, and have millions of miles of driving data for AI training. Of course, this is extremely hard to do. Most EV makers do not have access to a large amount of compute and millions of miles of driving data like Tesla. Tesla also has another competitive advantage. Tesla has a very large cost advantage and great economies of scale compared to most EV makers. Based on what I know, only BYD has a much bigger cost advantage than Tesla because BYD also produces its own batteries. Right now, Tesla's average cost per vehicle is very close to $36,000. This is much lower than most EV makers' average cost per vehicle. Most EV makers have to sell their EVs at huge losses in order to gain market shares because they have not achieved large economies of scale like Tesla and BYD yet. I believe Tesla's average cost per vehicle will continue to decrease over time because Tesla will continue to improve its manufacturing processes, look for more ways to cut costs, ramp up Cybertruck production, and introduce the next-gen platform that will likely have lower manufacturing costs. Here is another reason that will help Tesla's EV business recover over the next several years. I believe this will be Tesla's biggest growth driver over the next 5 to 10 years. Tesla is expected to start producing its next-gen $25,000 EV by the end of 2025. This means Tesla will likely start mass producing its next-gen vehicle starting in 2026. Of course, this assumes that Tesla will not have more delays. Tesla is planning to use a new unboxed manufacturing process that will likely decrease Tesla's manufacturing cost. This will help Tesla mass produce its $25,000 EV and still make a profit from it. Elon Musk said this during the most recent earnings call. Tesla is currently between two major growth waves. We're focused on making sure that our next growth wave, driven by next-gen vehicle, energy storage, full self-driving FSD, other projects is executed as well as possible. I'm often optimistic regarding time, but our current schedule shows that we will start production towards the end of 2025, so sometime in the second half. That's just what our current schedule says. But there's a lot of new technology, like a tremendous amount of new revolutionary manufacturing technology here. Elon Musk admitted that he's often too optimistic when it comes to releasing new products and vehicles on time. Realistically, if Elon Musk expects that Tesla will start producing its next-gen $25,000 EV near the end of 2025, Tesla may delay it until 2026 or even later. Here's the third reason that I believe will help Tesla's EV business recover over the next several years. The Fed is planning to have 3 rate cuts in 2024 and have more rate cuts in 2025 because the US inflation is gradually coming down to the 2% inflation target. Of course, when the Fed starts lowering rates, car financing rates will also be lower. I believe the EV market is very similar to the housing market. The EV market has been hugely impacted by high interest rates. EV demand has slowed down a lot in recent quarters, mainly because of very high interest rates, and not because customers don't want to buy EVs. High interest rates make EVs much less affordable than before because high interest rates make monthly car payments much higher. Once the Fed starts decreasing rates, I believe many customers will start buying EVs again, and Tesla can gradually increase Model 3 and Model Y prices again, which will improve Tesla's gross margin again. I want to show you Tesla's estimated growth going forward so you will know whether Tesla's business will eventually recover or Tesla is a zero growth company. According to Seeking Alpha's consensus revenue estimates, Tesla's revenue is expected to grow about 12% year over year in 2024. Then Tesla's revenue is expected to grow faster over the next several years. I think the worst case scenario is that Tesla's total revenue may not grow at all in 2024 if Tesla cuts prices too much. But after 2024, I believe that Tesla's revenue growth will recover because interest rates will be lower. Tesla will likely earn more revenues from FSD going forward. The Cybertruck will start contributing more gross profits to Tesla going forward. Tesla will eventually release the next-gen $25,000 EV over the next several years, and Tesla will continue to introduce new manufacturing processes that will likely decrease its manufacturing costs and decrease the average cost per vehicle going forward. In terms of EPS forecast, Tesla's EPS is expected to drop in 2024. This is expected because Tesla will likely cut more prices in 2024, which will hurt Tesla's margins. After that, once interest rates start to drop, Tesla's EV business will likely start recovering. This is why Tesla's EPS is expected to grow much more starting in 2025. I want to show you this valuation comparison between Tesla and the other Magnificent 7 stocks including Nvidia, Microsoft, Apple, Google, Amazon, and Meta. Here you can see that Tesla has the highest forward PE and the highest EV to EBITDA. The biggest reason is that Tesla's revenue growth and EPS are expected to decrease a lot in 2024, so these two forward multiples are much higher. Just to compare, Apple, Google, and Meta have the lowest forward PE and the lowest EV to EBITDA. This suggests that Apple, Google, and Meta are likely much more fairly valued or even undervalued. I want to show you how to calculate Tesla's stock intrinsic value here, so you will know when Tesla becomes undervalued, fairly valued, or overvalued now. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Tesla's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe Tesla's revenue growth will grow between 0% and 10% year over year in 2024. 0% growth is the worst case scenario here. After that, I believe Tesla's revenue will grow at a compound annual growth rate CAGR between 12.5% and 17.5% annually over the next several years. These estimated revenue growth rates are much lower than Tesla's revenue growth before. I believe this revenue growth forecast is reasonable. Let's go over these three case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that Tesla's revenue growth will stay flat in 2024. After that, we're forecasting that Tesla's revenue will grow at a CAGR of 12.5% over the next several years. If we discount Tesla's free cash flows to the present day, Tesla's intrinsic value should be around $650 billion for the entire company, or $186 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that Tesla's revenue will grow 5% year over year in 2024. After that, we're forecasting that Tesla's revenue will grow at a CAGR of 15% over the next several years. Then Tesla's intrinsic value should be around $741 billion for the entire company, or $212 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Tesla's revenue will grow 10% year over year in 2024. After that, we're forecasting that Tesla's revenue will grow at a CAGR of 17.5% over the next several years. Then Tesla's intrinsic value should be around $841 billion for the entire company, or $241 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Tesla's intrinsic value should be around $213 per share. I also used the forward price to sales valuation model here to estimate Tesla's intrinsic value, which should be around $811 billion for the entire company, or around $232 per share. If we take the average of both valuation models here, I believe Tesla's intrinsic value should be around $222 per share. Just to compare, Morningstar gave Tesla a lower fair value of $200 per share. This means I believe Tesla is undervalued at the time of making this video. So will I buy Tesla stock? Yes, I will likely buy more Tesla shares going forward, only if it's still greatly undervalued below my intrinsic value estimate to reduce risk. I believe Tesla will likely have very low revenue growth rates this year and perhaps next year because of the biggest headwinds and risk I talked about earlier in this video. Over the long term, Tesla's long-term growth will be driven by the next-gen $25,000 EV, FSD, and future projects such as the autonomous humanoid robot. I believe Tesla's EV business and gross margin will start recovering once interest rates start to drop, but of course this will take time. This is my plan. This is not advice. If Tesla reaches nearly $1 trillion in market cap again, I will likely sell 50% of my holdings in Tesla and take some gains. Then I want to reinvest the capital in the other Magnificent Seven stocks such as Apple, Google, Nvidia, Microsoft, Meta, and Amazon because they have much larger economic moats than Tesla. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. I think it's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting the channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.